Hey guys, welcome back to the channel. Today we're going to go look through what's happening in the markets today and look at the portfolio. Obviously, we do that in every video. And we're going to go over some of the news events that transpired over the weekend and over the past few days. So if you like this content, please like and subscribe on YouTube and Substack. That's where all of my content is housed. So those two social medias are where you can get all bearded investor community information. So going into the market look, I'm going to share my screen on the stock heat map right now. So you can see that tech, specifically semiconductor trade, is down a lot. MU is down 6.66%. Avgo, Broadcom is down 1.52%. NVIDIA is down 2.12% ahead of their earnings on Wednesday. The hyperscalers are up a little bit, but pretty much flat. Apple up 1.19%, Google 1.26%, Microsoft under 1%. What's really benefiting in this trade right now is that money is moving from here and pretty much from the hyperscalers to industries like finance. You can see those are Visa is up today, MasterCard is up today, Berkshire, JPM, Bank of America. Retail spaces, Amazon is up, even though they're a hyperscaler, 1.57%. Costco, Walmart, HD, Home Depot. And then a lot of other smaller industries are getting the benefit of the semiconductor trade being down today, yields going down today after it's been hot for a minute and going up for a while. So consumer non-durables, consumer services, health services, things like that are doing well. So we're going to get into my portfolio and I kind of do a barbell approach where I have tech on one side and I have consumer discretionary and cyclical commodities on the other side. And what I've noticed is, not always, but what I've noticed is when tech goes down, some of that money flows in to those spaces. So it kind of hedges each other. If tech is up, those things are, flat to down, and then vice versa. So since tech and semiconductor trades have been kind of weak for the past 2 weeks, 3 weeks, I've noticed a huge influx. And this is not the only reason, but I've noticed a huge influx into those names, which I'll get into. So moving on into my portfolio on stock analysis. And if you want to get stock analysis, just find the link down in the description below. Sharing this, here is my portfolio, and it has gone up and to the right since last week. Started last week was the beginning of it pretty much. And this was sitting around 176,000 just maybe less than 2 weeks ago. So you can see how much things can change. It's up over $20,000 in less than 2 weeks. So this is the power of having a barbell approach. I did put a lot into HCC and AMR, which are Metco plays, and Celsius, which is a consumer play in the drink space. So I put a lot into these. That's why I'm enjoying the fruits of that kind of. And they have been up a lot. So right now I'm sitting on about $30,000 worth of profit on HTC, which is almost 125% up from where I bought it last year. And then I'm up about $8,000 on AMR, which is up 23%, 24%. Celsius, I'm up about 15.65%, $4,000. So these are the big players that have moved my portfolio over $20,000 in the past 2 weeks as tech has faltered a little bit. And we'll have to see what happens to tech because NVIDIA is going to report on Wednesday, and that is going to be the biggest bellwether in the semiconductor trade and probably the overall tech trade today. So over a $4 trillion market cap. If investors don't like their results for some reason and they fall, it's going to drag down tech and the semiconductor trade and probably hurt the hyperscalers as well, because everything in that side of the industry is kind of connected. There's circular financing, there's all sorts of deals there. So it is going to be kind of crucial to watch the NVIDIA earnings on Wednesday to make sure that everything is still intact. And we're really going to have to read into Jensen Huang's, commentary and writing to see if there's anything amiss in that industry. And then I have my IAUI, which is my gold, covered call gold ETF. And then I have my SCHD, which is my, dividend appreciation ETF from Schwab, and then my QQQI. And not surprisingly, the QQQI is faltering a little bit because, tech is down and it's been down for the last 2 weeks or so. So it is going down. I'm not really surprised. I'm not worried about this at all. Honestly, this is probably going to be more of a buying opportunity for me. So when I have more capital, when these dividends roll in, I'm probably going to reinvest here. It's already underweight a little bit in terms of portfolio weight compared to SCHD and IAUI. So I want to get at least up to that and then do a 40, 30, 30, 40% on SCHD, 30% on IAUI, and 30% on QQQI with incoming, paycheck money and other forms of, income and cash. I'm going to throw it in here, make sure my dividends keep growing, my income keeps growing, my cash flow keeps growing every month. And then I'm going to roll that into my growth stocks and vice versa. So these will feed off of each other basically. And that's my plan, my semi plan for the next few years. There's other things that I want to talk about with that plan, and I will give a holistic overview of that plan in another video. And I think investors that are interested in both growth and income, maybe a little later in their investing careers. I'm 38 right now, about to turn 39, almost 40. I want to be getting mainly growth, but I also want to start building up that income, that cash flow. I build up that income side of things so that I could fund my daily life and also add back to growth stocks when I find good opportunities. So if I don't have any cash or dry powder sitting around to capitalize on a great stock investment at a good price, what's the point of doing the research, So that's my thinking here. And I want to build this up as fast as possible so I can have that, engine working for me and providing me income and cash flow that I can use to buy more growth stocks that, fund this whole thing. So that's the idea behind here. And this is the look at my portfolio right now. Now, what am I doing beyond the ETFs? Nothing really. Everything's above my average cost. As you can see, HCC is way up above my average price of $49.3 per share at $110 right now. Google is also more than double, almost double. Oh no, more than double, 118.24% up. So not really adding there. I do want more shares, but it's kind of would be averaging up a lot. AMR, not going to do anything. That's already up at 23%. I might, if it did fall below 176, I'll probably make it even 200 or higher number of shares. Celsius, no, I think it's already gone up a little bit too much. I would get it under $30 a share if I could, because my average cost is $29.99 per share. And so, yeah, really, and Meta is probably the only one I would pick up really, or could pick up without increasing my average cost a lot. So that's where I would probably focus my money outside of the ETFs. But for right now, I'm just focusing on the ETFs, making sure that cash flow engine is steady and growing into the future. And looking at the overall portfolio summary, you can see this portfolio is wild. It's gone up. If you've watched any of my older videos, this number was not even close to what it is right now. And in the past 2 weeks, it's gone up over $20,000. So really grateful for all of these companies that I invested in and that they are printing cash flow and free cash flow to give back to investors like me and move up the stock price so I can retire earlier. So in a few years, 5 to 10 years, hopefully this is much, much higher. Today's profit, 4,258 approximately, up 2.2%, which is great. Dividend yield, blended dividend yield for this whole position is at 1.86%. It's been dropping because I haven't been able to add fast enough relative to the portfolio value going up, which is a good problem to have, but that's why it's dropping. And I'm planning on raising this aggressively with IAUI and QQQI. PE ratio of the whole portfolio is 47.4, which makes sense with the tech in here and with this Celsius, with high growth Celsius and stuff like that. So PE ratio is not the best indicator for looking at a stock's financials and a portfolio's financials, just because it's very, very easy to change the EPS of the company, the earnings per share of a company, which goes into the PE calculation. It's very easy to change that. Anything like buybacks or share offerings can change the EPS because it's earnings per share. So if you change the share count, you change the EPS, which changes the PE. And looking at growth stocks, you can't really even use a PE on some of these high flying growth stocks. They may be able to justify a 70, 80, or 90 PE ratio. It really is relative to the industry and the company that you're looking at. So don't just go by off PE and the PE ratio to justify or not justify a investment decision. It's not the best indicator. And I can go into another video and just about PE and fundamental analysis and ratios and stuff like that, explaining like what you should look at when you're analyzing a company. Okay, let's move on to what's happening in the world today. Right now, the main stories that showed up over the weekend were that, the US-Canada deal, and I talked about this on Substack Notes. The US-Canada deal fell through. It didn't happen. The US is going to hike Canadian auto tariffs to 50% as the trade war escalates. I'm not sure why we are having a trade war with one of our closest allies and somebody that we are neighboring, but that's where we're at right now. And so that's going to raise the prices of the imports that we get from Canada. Another story that showed up over the weekend is that Besant could tap nearly $1 trillion fund the buybacks that they've started doing already. So this number, 1 trillion, didn't show up till this weekend, and that just shows you the extent that they're willing to go to basically drive down yields, the bond yields. So what they're doing is buying back long-dated 20 and 30-year bonds to bring down their interest rates, the rates that they pay. So if you buy it back, you can lower the interest rates on those bonds. And that basically helps the stock market. And it basically helps everything else, like the stock market and things like that. So when yields go down, the stock market goes up, and other things that depend on the inverse relationship with the higher yields goes up. So you notice that it is a correlation. So when yields go down on the 30-year, you'll see the stock market be up. That's the extent at which this Treasury will go to, fund these bond buybacks and drive down the yield. And that's one of the big things. The bond market, if you don't understand the bond market is one of probably the strongest markets in the world. It controls basically everything. So the rates on those bonds determine so many different things. I would say oil and bonds almost control the whole money market. Stocks are relatively small the stock market is relatively small compared to the bond market. So this is super important, and it will affect things like the housing market, because the 10-year bond is what mortgage rates are kind of based on and get affected by. So everything is kind of tied to the bond market at some point or another. Lastly, I noticed a story about Alibaba going to raise debt with a share offering to basically fund their AI push. And so this is a Chinese company, but they have American depository shares. I've invested in this before. They are just following the same path that a lot of these hyperscalers are following, American hyperscalers are following, with raising debt, offering share buybacks, pursuing all of this negative stuff on their balance sheet to push out this AI. In the worst case scenario, if, NVIDIA shows drop or something, or doesn't impress investors on Wednesday, and we see cracks in this AI trade, the spend that these companies are doing on AI, on these chips, on these data centers, if it does not return an investment, each company is different. And so like a company like Meta already sees some improvement in their revenues from advertising, using AI inference and all of this stuff. So it is a nuanced topic. But if overall the hyperscalers don't see a huge increase or a increase in their revenues, commensurate to how much they're spending on AI capex, that's going to be a problem because they're going to debt. And how are they going to pay off this debt if they don't? How are they going to give shareholder returns if they don't get a huge return back for their investment? So you're seeing all of these once asset light, except probably Amazon, asset light businesses that are now getting very, very asset heavy, data centers, chips, all things that can be depreciated over years, that will have depreciation costs over years, getting very asset heavy with these things. And then what if they have nothing to show for it, or like very little to show for it? So that's the fear, I think, that has been pervasive in the market for months now. And every earnings season we see, amazing earnings. So far it hasn't shown up, but it has to continue. If they continue spending and spending on debt, then they will have to keep showing great results, great earnings, great revenues coming through to justify this. And so that's where we're at right now. And I just thought it was interesting that even, other country hyperscalers are getting into that same act. It's like they can't do anything different. Another thing is, if those models that are being created with these, chips, and if all of this investment is not needed to create a equivalent model, then what are they spending it on? You know what I mean? So some things like Quen from Alibaba or and things like that show very good results for maybe a fraction of the cost, and that also puts a damper on semiconductors and questions why these hyperscalers are spending so much to build these models. So we have to watch all of these things. There's a lot of nuance in all of these topics and a lot of associated industries to the semiconductor trade. There's cooling, there's memory, there's electricity, energy. There's so many other things. So what affects the semiconductor trade will affect hyperscalers and affect so many other industries that are connected to it. So we really have to be careful when we invest in something like in NVIDIA or AMD and Micron and stuff like that. There's tiers in quality. I mean, NVIDIA is probably the poster child for the semiconductor trade. So that is much less risky than, a SanDisk or something like that. I don't put the risk level the same. One is proven and has backlogs and tons of revenue and things like that. One is just up and coming into that space. They are posting those things, but it's just started to show up, and their share price reflects that. So we have to that there is different risk profiles within that same industry. Yeah, I thought that was interesting, and I thought I'd bring it up to you guys just to show you guys if you're not aware of that stuff happening in the markets right now. But yeah, guys, if you like this content, please like and subscribe, like I said in the beginning, and I'll see you guys in the next one. If I can get another one out this week, I will. Usually I do a portfolio update at the beginning of the video, so just to see what the change is. I'll show you both up and down, so you'll see if a play is not working or a stock investment is not working. But so far, my barbell approach is working well. And the last thing I want to do is talk about the option play that I'm thinking about doing. And I will talk about that in another video or article on Substack, because that looks very interesting. And I'm about to move my main portfolio from Fidelity to IBKR, Interactive Brokers. Once that's done, I should be able to do an option play that I've been thinking about for a while. And I'll describe that in my next video. Thanks, guys, for watching, and I'll see you guys in the next one.